On the Spot with Michelle Makori is brought to you by Swan Bitcoin.
Hello, I'm Michelle Makori. Thank you for joining us. We are a few days away from finding out if Bitcoin's mainstream moment has arrived and whether the SEC will approve a spot Bitcoin ETF. The Securities and Exchange Commission is expected to rule by January 10th on 14 different applications for spot Bitcoin exchange-traded funds, including from some of the biggest names on Wall Street, from BlackRock to Franklin Templeton. Now, Bitcoin has been one of the best performing assets of 2023, surging over 160%. And it started 2024 by rising above 45,000, its highest level in nearly 2 years, mostly on the hopes of this ETF approval. But the ETF is not a done deal yet, and there are other big macro events at play that could either be major headwinds bringing down Bitcoin or extremely strong tailwinds leading to a Bitcoin supercycle and its best year yet. Well, here to give us his outlook on Bitcoin and the US economy and the markets is Andrew Axelrod. Andrew is a global macro and Bitcoin commentator, as featured in Zero Hedge and Bitcoin Magazine. He's a top LinkedIn contributor with his posts averaging 1 million views monthly. He spent his career working with some of the largest asset allocators across America, Europe, and Asia Pacific, and now educates family offices and professional money managers on digital assets. And he also writes the Bitcoin Macro Substack. Good to have you back with us, Andrew.
Hi, Michelle. It's great to be back. It's always good to talk to the Kitco audience and get to kick off the new year together.
All right, and Happy New Year. And it could be a Happy New Year for many Bitcoiners if this Bitcoin ETF gets approved. So let's start there, because there is still a little bit of doubt lingering. And we did see a slight sell-off after a report by crypto investment services provider Matrixport saying that they expect that the SEC will reject the applications to list a spot Bitcoin ETF. In the report, the analysts at Matrixport insinuated that they'll reject this because of several reasons, including the agency needing more time, unfulfilled requirements, and perhaps most importantly, lack of political motivation. In a note on Wednesday, the firm said that the current 5-person voting commissioner's leadership, critical for the ETF approval of the SEC, is dominated by Democrats. And it added that SEC Chair Gensler is not embracing crypto in the US, and it might even be a very long shot to expect that he would vote to approve Bitcoin spot ETFs. Going on to say that from a political perspective, there is no reason to approve a Bitcoin spot ETF that would legitimize Bitcoin as an alternative store of value. So Bitcoin did sell off a little bit on the news. It fell around 5% in the day, has since made up some of that ground. I mean, what do you make of this? I mean, overall, do you take this report seriously, or do you think that we will get the spot Bitcoin ETF approved come January 10th?
Yeah, it was an interesting report. I saw that come out, and I mean, I guess congratulations to Matrixport. I mean, I've been hearing more about Matrixport than I've heard in the last couple of years because of this report. And you're right, it tanked the market, fell 5-8%. Honestly, I'm not even convinced that was the reason. I think there was just quite a bit of froth in there, and it might have just been liquidations, and that could have been a trigger event. But yeah, I mean, I don't know that people are taking this report super seriously. I don't know that I do either. If you dig into it, beyond what the points you just accurately mentioned, I don't know that there's anything more substantive than, okay, there's some political affiliations on the approving committee or whatever. I mean, fine. I think the people I've been listening to on this, because I don't have any insider information. I think the only people that know for a fact what's going to happen is probably Gensler and some intimate, or some people that are deep on the inside. But other than that, Bloomberg's business intelligence has been spot on. So Eric Balkudas, James Seifert, they have a track record of getting these things right, going all the way back to the GBTC lawsuit when people are saying they wouldn't have a chance of suing the SEC. And so they were spot on with that, and they've been saying for the longest time that this thing is pretty much a shoe-in. Even after this Matrix report came out, they were saying they were still putting it at a 90% probability. I don't know how they're coming up with these percentages, right? I'm kind of from the outside looking into, but I'll take their word over Matrixport. And so, yeah.
All right. Well, I guess the track record thing maybe isn't a good word here, because a lot of the enthusiasm and positivity that the ETF would get approved came by looking at BlackRock's track record and its track record of getting ETFs approved, which they've succeeded every single time except for one. And that's sort of in a way to many countered any sort of political motivations, thinking that, BlackRock, one assumes, has tremendous political influence. So if it's jumping into this game, it obviously expects things to get approved. So taking that information aside, taking your analysis from Bloomberg, does Andrew Axelrod think we're going to get a spot Bitcoin ETF come January 10th?
Come January 10th? I think there's a high probability. Again, I'm not an insider. I think the only one that can say it with certainty is Gensler, right? But I do think there's a good chance here. From what I'm hearing and from what you just mentioned, there's too many powerful actors here that have a vested interest to make this thing happen, including the BlackRocks, Fidelities, not the Vanguards, but Wisdom Trees, the Valkyries, all of these big players, including now also the AP wannabes, Goldman Sachs, clamoring to become an authorized participant as well. And so, most recently, JP Morgan becoming an AP. And so, yeah, I think there's too much tailwinds here to ignore. And so yeah, the way I look at it is, I almost take a leaf out of biology's book. He had a really interesting way of framing it, which is this is almost ceremonial, where this is a trade agreement between the traditional financial world and crypto, where this is, all that needs to happen now is sort of the biggest TradFi institution, which is the world's biggest regulator, the SEC. They need to, wave their magic wand and they need to give their blessing. Right. That would be an ETF approval. And at that point, they're basically saying it's okay now for wealth advisors to start talking to their clients at the local country club dinners about a Bitcoin allocation to their portfolio, that this thing is now kosher, it's been blessed. And so, yeah, I definitely think it's a question of when and not if. And given everything that we know, given all of these conversations that have been reported on, that seem to be a lot more constructive than, if you rewind a few months, you were listening to these issuers and they were saying they couldn't get anybody on the phone, and that's completely changed. And you would expect that these kind of conversations only happen if there's an openness and there's a willingness to, and from all reports, that's what's going on. They're sort of, now they're working out the finer details. It's down to the nitty gritty of the actual paperwork.
But what happens, for argument's sake, Andrew, if it does get delayed or even, rejected?
Yeah, I think it would surprise a lot of people first and foremost. And so there might be a pretty hefty market reaction to that, but it wouldn't change any of the fundamentals. You would still have those same backers. It wouldn't change BlackRock's mind. It wouldn't change Fidelity's mind. They still have a huge customer base that's pushing hard to get access to this new asset class. And so, maybe in the short term there'd be some effect, but in the long term, it wouldn't change anything.
Right. And arguably it wouldn't change the idea for everybody that's been holding Bitcoin way before the big institutions showed any interest in this. But let's talk about what happens next if it does get accepted and we do have these big players, because these ETFs would now allow everyday investors to get exposure to Bitcoin without having to own it, trading it like they would a stock. And one of the issues for people owning Bitcoin is that it is a bit challenging in terms of a barrier to entry to, firstly buy it on exchange. That's not that difficult, but to some it is. And then, of course, the issue of custody and storing it. So this is going to make it a lot easier for retail investors to get in on the action. And approvals could also expand, as you touched on, widespread acceptance of Bitcoin as a potential staple in 401ks, IRAs, pension plans, family offices. So if it does get approved, what kind of demand is expected to come after this?
Yeah, exactly. I think so. This is something that people might be sleeping on a little bit, and it's worthwhile taking a step back just to sort of examine what's at stake here. This has been something that's been talked about. An ETF has been the holy grail for 10 years, and it's been in the works, and people have been speculating that it might be coming for a decade now. And it looks like, it might be here. And there's a good reason that this has been the holy grail, because it'll just open up the door to a wall of money that's out there looking to allocate and that couldn't allocate. It's kind of funny. It's the reverse of what traditional finance people are used to. Usually they're used to the big money sort of, or the so-called smart money getting first dibs at the hot new thing. And they've been essentially locked out for 15 years. They had no way to really allocate, both in terms of size, but also in terms of the technical, issues of self-custody. And so, yeah, it's going to open up the door to, there's about $10 trillion of assets being held in ETFs right now. And I think 6 trillion of those are with iShares BlackRock products alone. And so there's going to be a certain percentage that's going to want to buy into this, right? And so, yeah, I want to shout out Peter Kruger here. If you haven't had him on the show, he's been really excellent tracking this. He was involved with the SPDR launch, the gold ETF by State Street back in 2004. And so if you listen to him, it's really history repeating, except on steroids this time, because when the gold ETF launched, that was with gold, right? One of the most established assets in the world, with a incredible history, 10,000, 5,000 years of history, universally accepted, even at the time, a significantly larger market cap than what Bitcoin has right now. And in 6 years, in the next couple of years, or 6 years after it launched, the price tripled. It went from I think it was in 2004 when it launched, it was trading at $600 an ounce, went up to just shy of 2,000. And so that, again, that's gold, right? What we're talking about here is an ETF for digital gold, it's been around for 15 years. That's nothing. And it's already, getting into this ETF game. And so I think the shock, it could trigger quite a shock.
A shock of the floodgates opening in terms of demand. You touched on a number there. You said 6 trillion. That's what you're saying is the current ETF allocation? Break that down for us.
Oh, no. Yeah, I was saying there's $10 trillion in ETF products in total. And 6 trillion of those 10 trillion are with BlackRock alone. And so that's why you mentioned BlackRock backing this. That's why it's so significant, because they're pretty much the biggest game in town. And as you were saying, yeah, it's going to be a shock in terms of this wave coming in. If you've seen The Shining, that's what you can imagine, except it's not going to be blood red. It's going to be green.
You always have very interesting, somewhat dark analogies and metaphors, but certainly very interesting. And look, I get your point that this is a very rare occurrence where the smaller money, the retail investors, have front-run the big institutions, the big money, that they kind of had the opportunity to get into this game in advance. I mean, everybody did, but that in terms of regulation, I guess you could say the institutions didn't, but that is a pretty rare occurrence. So would one expect to have tremendous demand coming once this ETF approval happens, and as we said, added to a range of products. Another factor here is that we also have the halving in April. So we've got the demand side, but then on the supply side, we have the halving, and that's an event that occurs when the reward for mining Bitcoin transactions is effectively cut in half, and the halvings reduce the rate at which new coins are created. So then it lowers the available amount of new supply. And last time we had a halving was on May 11th of 2020. The next halving expected to occur in April. The block reward expected to fall to 3.125 there. And historically, halving events, because they reduce the reward for mining new blocks and therefore the rate at which new Bitcoin is generated, they have been associated with significant upticks in Bitcoin's price. So if we have this reduction in supply coupled with the steady or dramatically increasing demand, what does that mean for your price forecast for Bitcoin?
Yeah, it's kind of, you couldn't write this stuff. Like you were saying, it's kind of just lining up. It's ridiculous. It's almost like somebody planned this And this is something I think Max Kaiser points this out. The timing with Bitcoin is just impeccable from its inception in 2008 with a global financial crisis when it was first launched, and that it coincides with these political cycles. So that's another thing, right? We're going into an election year now, and at least the future market is pricing in rate cuts, which maybe we'll get into. And so that's lighter fluid. Then on top of that, the halving, which you just talked about, it's we're going into the fourth halving. It's forecasted for April 22, but it's an estimate. We don't know the exact date. It's Bitcoin's logic goes by blocks, so it'll be at block 840,000, whenever that is. I think we're around 8 block heights at 820K or something like that last time I checked. And so that's lining up as well. And then the ETF that you just mentioned, which is going to give access to, it's going to be Bitcoin going on sale at every brokerage in the country, pretty much. And so, any one of those things would be rocket fuel, but you take them together and it gets ridiculous. So here's what I learned about price predictions. I'm terrible at them, and so is everybody else. Okay, I just want to say that up front. And I've learned that, especially during these last 18 months. I mean, nobody called the double top of Bitcoin when it went to 64K, dropped down to 20, went back up to just under 70, went to 69. Then as it was on the way down, people were calling for 10K, which it never. I think there's some people, I'm not going to name names, there's still some people out there waiting for 10K apparently. But so the thing is, price predictions super difficult, especially getting the timing right. And so I'd be more what I'm more comfortable with is sort of a general trajectory, right?
All right.
And so and that's one of the cool things about this cycle, which is now you're getting the big boys and girls coming into this space, and you sort of have these, very, posh and respected institutions that usually they're sending you marketing material for some boring, whatever real estate fund. But now they're speculating on the Bitcoin price, just like everybody else on Twitter. And so why not? Like, I'm gonna lean on some of those predictions, right? So you have Jan van Eck, for example. He was saying a new all-time high within 12 months, which, given all those factors we just talked about, that seems reasonable. I think Standard Chartered had their own prediction. They were saying over 100,000 by 2024. I don't want to get that wrong, but let me just see if I can pull that up.
I think that sounds about right with consistent with what we were.
That's ballpark, right? So that was Standard Chartered. That was Geoff Kendrick. He was saying 100,000 by the end of 2024. Then you have, and I'm sorry, I might have gotten his name wrong before, so I would definitely want to correct that because he's been putting out really good content. Fred Krueger. I don't know if I said Peter Krueger, but it's Fred Krueger. He's expecting potentially, I don't want to put words in his mouth, he was saying 500K top in this cycle. So, I mean, those are all numbers. That's all within the realm of possibility. You've got Lynn Alden. I think she was saying she'd be disappointed if it didn't touch 200K during this cycle, between 150 and 200K. So I'm going to put myself in that camp. I'm like generally, bullish. You could almost say.
Bullish. Again, now you've used the term cycle. So what do we infer from that? I mean, there's a lot of, as you said, fuel suggesting that this could be a Bitcoin super cycle. And I'll get into the idea of potential liquidity coming into the markets with the Fed and the macro economy in a little bit. But when you say cycle, what do you mean by that?
Yeah, that's a great point. So I guess cycle is historically Bitcoin has a halving event every 4 years. So one of these 4 years is one cycle. It's one epoch. And so for people that have been in Bitcoin for a while, they tend to think in these terms of cycles. At some point, maybe a cycle is going to break down. I think that you mentioned the super cycle. That's where I think Dan Eld originally coined that term. But what it essentially means is that a super cycle is just when the cycles essentially break down and you start getting you start getting price action that seems to break this pattern of. It's usually again a 4-year cycle. So out of those 4 years, it's 3 years of green and one year of red. And so a super cycle would imply that, and it's feasible, especially with all of these new entrants coming in, because this isn't just a one-time event. This would be, as you were saying, these would be pension funds. These would be all kinds of allocators putting in a steady stream. It's a little bit a cookie cutter, but essentially what's happening here is they now have a fixed allocation to this new asset class, which they will be able to access through an ETF. And then it's just a question of, all right, every quarter or so, we got to rebalance, and the money keeps flowing and flowing. And that could sort of, and the dimensions here would, break all of the, what we've seen from retail traders up until now. So that's what a super cycle would mean here, which is that there's a steady stream that's pouring into absolute scarcity, and that would have, a shock on the price, and it would break this 4-year cycle. Is sort of at least that's sort of the thinking behind a super cycle. We haven't seen it yet. Might not happen this time, but yeah, when I'm talking about a cycle, that's what I'm talking about.
Do you think we'll get the super cycle then?
I thought we could have seen it last time, because you started seeing companies putting it on their on their balance sheets. Now, admitted, it was pretty much just MicroStrategy and maybe Square, but yeah, I think it's a definite possibility. I mean, as this thing becomes more acceptable, you see more mainstream, more institutional adoption. It'll become just another fixture. It'll just become another tick the box exercise on these investment committees. And so yeah, I think the thing is, there's always a moment in time where it's sort of that last price that you've seen. So for example, when I first got into Bitcoin, the price was around 300, and there's no going back. Like, I'm not going to see that price. I'd love to see that price again. I'm not going to see it again. And so at some point,
well, you'd love to see it so that you can pick it up again at 300, is I guess what you're saying.
Exactly. I would love a time machine, is what I'm saying.
Okay. So you're saying, though, that 2024 could set up Bitcoin for a super cycle.
I'm saying it's a definite possibility.
Definite possibility. You're really hedging today, Andrew, not giving us forecasts, definite possibilities.
I got ahead here.
Let's talk, though, about the idea of these institutional investors not necessarily being a positive for Bitcoin. I mean, it could be good for the price, but it may not be good for the overall mission and ethos of Bitcoin. And, one point here, BlackRock, the world's largest asset manager, they'll have centralized custody of a big chunk of Bitcoin with a spot Bitcoin ETF, because you need to have custody of the asset for a spot ETF. That's the difference there. And if you have institutions with centralized control, and then Bitcoin not being held independently, not being held in self-custody, not being used as a medium of exchange or a currency, that takes away from the decentralized money mission of Bitcoin. And that bringing it back into the traditional financial system that we just discussed is a negative. I mean, it was supposed to be an alternative to all of these big players and pension funds and ETFs and derivative products. So do you see this then as jeopardizing Bitcoin's decentralized ethos and problematic for the broader mission?
Yeah, I hear you. And that, by the way, that question, that's something that keeps me up at night. So I do think about that a lot. The only thing here is, though, I don't know that there's any way around it. So at some point, this was Bitcoin is an open source protocol. It's being market tested right now. It's been market tested for 15 years, and it's going to continue to be tested. So it's going to have to, in order to succeed as a money, which is one of the tallest orders, it's going to have to overcome every test that's thrown at it. And so if it can't stay meaningfully decentralized during this next adoption wave, then it was never going to make it anyway. And so, yeah, I think ETFs, I mean, again, people were expecting ETFs since 10 years ago. It looks like that moment may have finally come. And so if it can't survive ETFs, there's no way it was going to survive, more aggressive possible government action or acts of sabotage. But again, I do want to say, Bitcoin now is probably certainly a lot more robust than it was during the block size wars back in 2016, 2017. And you can't forget, you had at the time, was some of the most powerful VC money. It was some of the most high-powered, most badass, business people trying to make Bitcoin their own, essentially, and corrupt it in some way. And so, I think Bitcoin's been through a lot. And at that time, it was it had a lot less adoption. It had a lot less people that actually even understood it. Had a lot less of a user base, and so that's what makes me more positive. Which is there's a ton of people now that have adopted this. They're using it as a store of value for a significant portion of their wealth. They understand the use case for it. They support it, and so I think this is also borne out by the numbers. 80% is, last I checked, or at least it was in the high 70s, haven't moved their Bitcoin in over a year. And these aren't institutional investors. These are sort of, these are people like you and me. These are retail hodlers, and they're going to continue to accumulate. And a lot of those people are going to want to make use of one of Bitcoin's main use cases here, which is self-custody. And so in general, I think ETFs are positive. It gives access to a whole new user base. It gives access to more traditionally minded people that otherwise, or more deep-pocketed people as well, that otherwise wouldn't be able to get their exposure. So it's going to be beneficial for price. And then at the same time, those people that want to buy and hold, they're still going to be able to do so. But to your point, yeah, I think there is a risk of centralization, but that's a test that Bitcoin is going to have to pass.
All right, let's zoom out now and get your take on the macro picture, because there are a lot of variables there. Mixed projections regarding the U.S. economy, soft landing, hard landing. If we have the Fed cutting rates, that could create more liquidity, so that could be good for Bitcoin. On the flip side, aggressive rate cuts could mean that something is seriously broken, that the economy is slowing down too much and forcing the Fed to cut, and that environment could potentially be bad for Bitcoin. So before we break down the implications for Bitcoin, what is your overall macro outlook?
Yeah, I think it's really interesting. So people are talking, the big debate right now is soft landing, not soft landing. I think that's probably the wrong framework. So a good rule of thumb is finance is always 6 months ahead of the rest of the economy. That's because it moves fast, it's forward looking. These are just financial assets, so they can move on a dime. And so we're having this has been it's been the party like it's 99, right? It's been the best year for stocks since the 90s. I mean, you've got the Magnificent Seven, the big tech stocks, they're up almost 100% for the year. Bitcoin, you mentioned, was up 160%. The S&P is doing pretty good too, almost 30% when I checked. And so it's been amazing for stocks. The rest of the economy, as usual, is lagging 6 months behind, and it actually looks pretty grim. I mean, credit card debt just passed $1 trillion in total. You have 20% of retirees are now back on the market with a part-time or full-time job, and 7% are looking for work and can't find it. And housing affordability is at its lowest. And so when people are debating whether there's going to be a soft landing or not, I think we already have the answer. I mean, the landing's been super hard. Like if you ask the average person, like they're struggling with groceries, they're struggling. The only bright spot here is probably energy prices. Those have been kept in check. So and that's no thanks to money printing or anything like that. I think it's mostly just we're getting more efficient, we're getting better. We have more oil reserves now than we've had at any point in history. That's fracking. That's being able to open up some of these reserves that weren't available before. So that's been the only thing that's been able to stave off some of the more serious, stuff that could happen in this kind of inflationary environment. Stuff that can, lead to riots and the kind of stuff that can bring down governments, because once people really start struggling, when they're, starting to pay, $1 per kilowatt hour, and they can't heat their home, and they can't feed their family, that's when trouble really starts. And so cheap energy prices, it's kind of staved that off. But other than that, I mean, it's been, which has nothing to do with monetary policy. That's just been sort of technological and efficiency gains that we've made since the 70s. But other than that, I mean, we're seeing the really dire consequences of rampant inflation.
I get that. And I get that that's how it feels to individuals. Certainly when you're paying your rent or paying your groceries or trying to buy anything, that is still very much felt. But, according to the official government data, the economy is doing pretty well. Again, I'm not saying that this is a real reflection of what's happening, but if we take recession as measured by GDP, and the technical definition of a recession is 2 quarters of negative GDP, even though the Biden administration has wanted to, change that when it didn't suit the narrative. But the final GDP numbers that we got recently showed that the U.S. economy grew at 4.9% in the third quarter, 2.1% in the second quarter, 2% in the first quarter. And the estimates from the largest banks, they're leaning towards a soft landing in 2024. Both Goldman and JP Morgan see U.S. real GDP at around 2% in 2024. Morgan Stanley, Bank of America see it at around 1%. So they are not expecting a hard landing or a recession, at least according to the technical definition as reflected by the official government data. I get your point that things feel differently from what the government data suggests. But what do you make of this idea that, the big banks are team soft landing, it would appear?
Yeah, I mean, it's such a good question. I think it comes down to framing. So I think they're right, but for the wrong reasons. So they're saying like there's going to be a soft landing, but I think that's because we've already had the hard landing, or we're living through it right now. And by the time, the so-called soft landing comes about, it just means that we're sort of coming out of it. And so it reminds me a little bit of pre-perestroika, Soviet Union. And we can go, maybe we don't want to go on too much of a tangent here, but these reports, they're just not particularly credible. One of the most counterintuitive, most interesting example of this is, for example, crime, right? And so the crime numbers, they look really good in San Francisco, for example, until you realize that why are they looking good is because people aren't reporting crimes anymore. Because if their car gets broken into on the street and they call the police and they get laughed at because we've got bigger fish to fry, what happens? They stop reporting this, right? And then magically the crime numbers start to drop. And then it's the headlines all read crime's dropping. It's the country's the safest it's been since before the 90s. And so it's a similar thing with these CPI numbers, for example, where, short example, steak gets too expensive, people stop buying steak. They look at the central planners, they look at the reports, they go, oh, why steak isn't being consumed anymore? So it's not representative. So we're going to take it out of the reports. And then what happens? CPI drops, right? And then you have prices exploding everywhere else. That pushes up GDP numbers. But GDP is getting, or when they talk about GDP growth, they're talking about quote unquote real GDP growth, which is really just GDP being offset or discounted by this fake CPI number that we just discussed. And so you get a completely twisted view of reality. What you really want to be looking at is some things we just mentioned. Was credit card debt is a good one. How many seniors are coming out of retirement and back onto the workforce, drug overdoses, suicides. Like these are real numbers. And that's a much better, I think, indication of how people are feeling economically.
Yeah.
Yeah, sorry, go ahead.
And I get it. I get that, you have statistics that can be manipulated to suit a narrative that you want. You've got lies, damn lies, and then statistics. And then I can't remember who said that famous expression, which I may be misquoting a bit. And then you've also got data depending on how you choose to collect it, how you choose to present it. I get all of that as well, and that it's not necessarily reflective. We are, though, still seeing, the equity markets doing well in this environment. To be seen how it maintains. Hasn't done so well to start off 2024, but still, as you mentioned, some pretty dramatic gains for 2023. But having said all of that, then, what are you expecting in terms of the Fed going into 2024? What kind of Fed action do you anticipate?
Yeah, I think they're going to get pretty dovish. And so I think the market's already pricing this in. If you look at, before the December FOMC, the market was pricing in between 4 and 4.25, which would have been about 4 quarter cuts. But then ever since Powell came out and essentially reading between the lines, he was declaring, in victory over inflation. He was hinting at that there's going to be cuts coming up. And so now after that speech, the market is pricing in a Fed funds rate of 3.25%, which would mean 6 quarter point cuts until end of year. And so and this also coincides with the election year that we talked about. You can't have, the Great Depression 2.0 when people are about to hit the voting booths. And so taking all of that together, I think they're gonna retrofit the narrative to the reality, which is we've had the hard landing. People are really feeling it. Asset prices are 6 months ahead. They're already factoring in a pivot and stark cuts, and it's gonna be party like it's 99. And so that's sort of what I'm expecting. That's not a good thing necessarily, because it's just completely divorced from economic reality. But I do think I am expecting a pretty dovish Fed.
All right, but I don't know that Powell went so far as to declare victory over inflation, nor did he explicitly say that there would be rate cuts. He just said that the base case is for no more rate hikes, and then mentioned that several members on the committee are looking at rate cuts, and the dot plot would indicate 3 rate cuts. But I would take a step back from saying that he was taking a victory lap when it comes to inflation. But how dovish do you think the Fed is going to be? So you're expecting one first rate cut in March, and overall, how many cuts?
Yeah, fair enough. They talk in riddles, and I think that's also kind of the point. To be fair, Powell, he's not as bad as Greenspan and some of these others.
Again, Powell was the guy that assured us inflation was transitory, so I get all of that as well. And yes, part of this exercise that we decipher Fed speak, but nonetheless, what are your expectations in terms of real action, in terms of how many cuts do you expect for 2024?
Yeah, honestly, I'm going to have to go with the markets here. They're wrong and they'll correct. But you get into trouble when you get into exact figures, because nobody really knows. I think the trajectory is going to be dovish. They're going to have to cut. We just had, for the simple reason that, first of all, again, the election year, people are miserable. But maybe even more importantly, that's unaffordable at this point. So just the interest rate payments alone, that's the biggest budget line item now. So overtaking military spending. And so we're essentially broke, right? So you have to lower rates, and we're pretty much there. And they'll say the narrative will shift, and they'll make it fit. But the reality is they have to cut. And so, I'm going to go with what the market's pricing right now, which is between 3.75 and 4 for the Fed funds rate. But it could, depending on what's needed, it could be more, could be less, but I think that's the general direction.
So then how do you see Bitcoin reacting to this? Because on the one hand, it's liquidity. On the other hand, it could signal that things aren't so great, hence the Fed is looking to cut. How do you see Bitcoin reacting to the Fed cuts?
Yeah, Bitcoin got criticized for not being a good inflation hedge. I think it's been an excellent inflation hedge, quite frankly, over the last 15 years, ever since it got launched. And so, I think cheap money, it's great for Bitcoin, same as it's great for the top 7 stocks of the NASDAQ, same as it's good for all of these asset prices. I think, if anything, Bitcoin's a lot more attuned and sensitive to it. And so, I think it's going to trade for the most part based off of global liquidity. So if you, I think it was GMI that did a really excellent study where they mapped on they took the five largest central banks balance sheet, and they offset the S&P 500, and it was like a 97% fit. And so, yeah, I think liquidity is going to drive all of this. And I think if that's true for the S&P, it's 10 times as true for Bitcoin.
So you expect markets to continue to rise, equity markets to rise as the Fed starts to cut?
Yeah, I think once the cheap buddy spigots get opened up, that's always excellent for asset prices. It's a sad fact that it has really nothing to do with how the regular person is doing, with how the real economy is doing. But these things just trade off of liquidity essentially.
So you see the real economy, which is harsh, if I may summarize, forcing the Fed to cut rates quite aggressively, which will lead a equity rally to continue and will also be another sort of a vector that's positive for Bitcoin, because you've got the liquidity, and also because this could be a sign of, more money out there, and Bitcoin is supposed to be a store of value and also a counter against inflation.
No, that's really well put. And I think the other thing here is it's something to be aware of. It's a bit of an illusion, which it's counterintuitive, but it also happens to be true. And anybody at home can do this. You can take the S&P since 1929 and you can offset it by the money supply growth, M2, and you'll see that it's actually never recovered since 1929. Of course, there's been huge winners within that basket. There's stocks that have made people rich, but if you're just a passive investor and just trying to hedge inflation, you've barely hung on. And so, yeah, it's.
Wait, so you're saying when you look at the appreciation of the S&P 500 versus the real purchasing power of the dollar, is that what you're saying?
Yeah, exactly. It actually hasn't moved since 1929. I know some people have done the same exercise. Again, I think GMI did this with global liquidity with the five largest central banks for the S&P since the 70s, and it hasn't moved either. But you can run the same experiment by offsetting the S&P with M2 since 1929. And you'll see it hasn't moved, which is, people can't believe it, but it's also true. I think the illusion is that, as said, energy prices, those have come consistently down. I mean, a barrel of oil has been at like $70 for like 2 decades now, but in real terms, oil is about as cheap as it's ever been. And so that's what's really sort of maintaining people's living standards and making them feel richer, because it stretches your dollar out. But nobody's really getting rich just from investing in the stock market, which is counterintuitive. But
well, again, I mean, it depends what stocks you picked, and I get your broader point, though, that when you look at the declining purchasing power of the dollar and inflation, that the stock markets have just been a way to, in a way, preserve your wealth, not necessarily dramatically grow your wealth. I think that's what you're trying to say there. You mentioned oil, though, and of course, then one needs to bring in potential geopolitical tensions and developments that could change the fact that oil has been relatively stable. Are you factoring those in when you have your Bitcoin thesis for 2024?
Oh, I'm glad you mentioned that. That is the wild card. So if you look at what's happening at the Strait of Hormuz, yeah, it could really go. It could go tits up. Sorry for the language, but it could go bad. And yeah, I think this whole thing is sort of turns on whether energy prices can stay low or go lower. But you're right. If there's some turmoil, if they shut down, if they blow, if another pipeline gets blown up, who knows, right? That could be a wild card. I don't think it's going to impact. If anything, it might be great for asset prices. I'm trying to think back when the Nord Stream pipeline got blown up. I want to say that was massively positive for asset prices, which is it's almost it's kind of sick, because you think, oh, that's like how could one of the largest energy infrastructures in the world going bust? How could that be a good thing? But what it really is again, these assets trading off of expectations of money printing and loosened liquidity. Right. Which is like, yeah, of course, like if people in Germany can't heat their homes anymore because they can't they can't get gas or oil, then they're going to get handouts. There's going to be UBI, basically, which is a portion of that's going to go into the stock market, and that's what these assets are trading off of. And so it's weird. Bad news is sometimes terrific.
Well, bad news is good news in the sense that it means that there'll be more liquidity and softer central bank action. But at some point, Andrew, one can say that narrative shift. At some point, bad news is just bad news. Right?
Yeah, that's right. At some point, bad news is bad news, and you don't want to have Tesla stock, and instead you want canned food and gunpowder. Yeah.
Well, I mean, I don't know that I'm taking it that far necessarily, although some of the guests that we've spoken to say that is on the cards for 2024, that is not something that they're ruling out as a possibility for 2024. But what I mean to say is that when you have a Fed overprinting, at some point, even that idea starts to catch on, that things, aren't really as they appear. They even start to catch on to the general public. As we start to wrap up here, I do want to touch on a point that we discussed when we last spoke, which was in May of last year, and it was quite recently in the wake of the First Republic collapse. And the expectations were for commercial real estate to be the next shoe or anvil to drop. You were saying that, Elon Musk was saying it, Charlie Munger, may he rest in peace, was saying that expectations that commercial real estate couldn't withstand these high Fed rates. And you were expecting more bank failures and more consolidation of the banking sector. Now, we didn't see that. We saw the Fed continue to raise a little since then, and we didn't have any further collapses. So what do you make of that?
Yeah, it's interesting. I think the financial system really learned its lesson since 2008. And so they set up this PTFP program, right, which is essentially yield curve control for banks. But it's a bailout, right, in so many words. They don't want to call it that for political reasons because they want to have a next round of Occupy Wall Street. But that's what it is. And it's actually never stopped. So they started hiking rates. They hiked rates at the fastest pace in history back in March of 2022. And basically at that point, the countdown started. Fast forward a year, March of 2023, and they had to start. You had all these banks starting to go bust, and they had to bail them out. That's not what they said, but that's what they did. And this BTFP program, they track it, and you can see it started at like 15 billion, then went up to 50 billion, and that's kept ticking up. I think we're at 130 billion now, and we just had another spike back in December. And remember, this is banks on the cusp of default, and this is basically their last Hail Mary. Like, they're stuck, they need a bailout, they're able to get face value for their bonds, and they participate in this program. And so we've been seeing that it hasn't let up. And so without this BTFP, without these bailouts, I think we would have seen a lot more calamity.
But are you expecting more bank failures in 2024, or do you think that sort of crisis is over, especially in light of the fact that we'll, according to your forecast, see a more dovish Fed?
Yeah, no, I think they're going to be too quick on the trigger. I mean, so what happened? What happened back in 2008? There's this amazing story about Hank Paulson, who was the Secretary of Treasury at the time, and it's reported how, and it's been redacted now looking back, and it's made into sort of a moment of levity, and they made it a little less serious than what it really was. But he was in the Roosevelt room together with all the most powerful men and women in the world, and they were playing politics with the bailout, right? They were throwing out numbers. We need 700 billion, we need 800 billion, and Nancy Pelosi was basically the last holdout because she was trying to get some political favors for supporting this. And it's reported that Hank Paulson, in a moment of desperation, he just collapsed on his knees and he was begging her because he knew what was going to happen if they didn't get that bailout, right? He knew that they were about 2 days away from the ATMs running dry. And so they're not going to do that again. I think they learned their lesson.
Okay, so you don't see bank failures happening in 2024. There was a a boost for Bitcoin, actually, as we saw the banks fail, because it led people to really question the traditional system, and they went into Bitcoin as a safe haven there. So as we wrap up, Andrew, overall, your outlook for Bitcoin for 2024.
So just to summarize, super bullish. Let me say that. Let me go with, it's those three events that we talked about, Bitcoin's halving, the ETFs, and a potential dovish pivot. Those are going to be rocket fuel, in my opinion. And I'm going to go with Standard Chartered. Yeah, I'd be disappointed if we didn't break above 100K.
All right. Well, there we have it. Thank you for sharing your thoughts and insights with us. We will check back with you in a few months and see how those forecasts shape up. But always a pleasure hearing from you, and always enjoy your little historical anecdotes along the way. So thank you again, Andrew Axelrod. Really appreciate it.
Thank you, Michelle. My pleasure. Looking forward.
All right. Thank you, Andrew. And again, a special thanks to our sponsors, Swan Bitcoin. Now, Swan Bitcoin does, in fact, offer service to high net worth individuals, businesses, and trusts, and that's the Swan Private service. And it offers a comprehensive Bitcoin investment platform with services like institutional level liquidity, concierge OTC service, inheritance and estate planning, tax loss harvesting, and more. So if you're interested in that, there is a special link for Kitco viewers in the description of this video, as well as other information on other Swan Bitcoin products for a range of people interested in getting into the Bitcoin space. Now, until we see you next time, thank you so much for watching. From me, Michelle Makori, and the rest of the team, we'll see you soon.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin. Swan Private is proud to be your partner on the journey into Bitcoin. Swan Private helps high net worth individuals, family offices, businesses, and trusts. Expert service, real relationships. Go beyond legacy finance. Build your own legacy. Swan.com/wealth.